Morning, everybody. My name is Phil Snooks. I'm with IBANZ. This session is material damage business interruption with a twist. And I've got Matthew Noy, senior underwriter from QBE, to front the thing for us and kick it off. So I'd like you to give a warm welcome to Matthew. Thank you.
Well, yeah, my name's Matthew Noy. I'm going to be running through this MDBI workshop with you today, along with Phil Snooks. Now, before we start, I'll just explain a little bit about my background. I won't go into it in too much detail because my bio was on the IBANZ program. I'll then outline how the session's going to work, and I'll explain why Phil is here and what he's going to do. And trust me when I say you're going to get enormous value from having Phil here. But more on that in a minute. In terms of my background, I've been in the industry about 22 years. A lot of that time is property underwriting, as you'd probably hope and expect. For the last 4.5 years, I've been with QBE, and I manage a portfolio there across all lines of business and with a staff of 10. In the early 2000s, I was fortunate enough to have the opportunity of working in Australia, so I got exposure to a much bigger market. And I think I learned more in 3 years in Australia than I did in the 10 years before that. Not because they do things any better, but because they did things a lot more old school over there. And so, in terms of underwriting, you know, it was you priced glass and you priced burglary and fire and accidental damage, and so, you know, it was really good from that point of view. But the thing that has helped me the most in terms of interacting with brokers is that for about 10 years I was one. And what that means is that I'm acutely aware of the different pressures that brokers face versus underwriters, and they are very different pressures. And so having been on both sides of the fence, I'm a huge advocate for that mix of experience, and I genuinely believe that it makes me a better underwriter having had that. Okay, on to today's session. This is an MDBI workshop, and the thing about a workshop is that it's a workshop. It's not just me talking for an hour. That would be much easier for me, but a lot more boring for you. I'm going to... everything today is based on a client scenario, a client interaction, which Phil's going to talk about. And the beauty of this scenario, when Phil first took me through this scenario, I thought, oh, this is a really good case study because it's got some really good points, but it's an actual, real-life example, so it's that much more relevant and interesting. What we're going to do, Phil's going to outline the scenario, and then you've got a handout with some facts and some background, and so you're going to go through the facts, combine that with what you've heard from Phil, and then you're going to come up with some recommendations and ideas about how you should structure the program. Okay, everything about this is about the structure of the program. There's nothing about price. This is pure. Everything here is conceptual. Okay. In terms of the outcomes for today, we're going to be covering calculating gross profit based on a profit and loss. We're going to be reviewing the adequacy of sums insured. We're going to be reviewing the basis of settlement on plant, and I can't overemphasise the importance of basis of settlement. It's just so important. You know, I've had so many situations where people have come to me and they want to insure something, and and just off the top of my head, an example is when I was in Australia, a broker came to me and said, I want to insure these. It was a university, and I want to insure these textbooks that were hundreds of years old, and they wanted to insure it for $2 million, and they said, you know, can you hold covered? I was like, yeah, fine, no problem. I don't know what you think you're going to get in the event of a claim, but you know, if you think you're going to get $2 million, or you think these things are worth $2 million, then you better sort out the basis of valuation. So that's a really important point. We're going to be reviewing the position on customers' goods, another really important part. And there's some other little nuggets in there as well that hopefully everybody picks up. Now, to discuss the scenario itself, I'm going to hand over to Phil in just a minute. As I said, when Phil went through this with me, I thought this was a really good example. And the good thing about it, and the main reason Phil is here, is because it's his client, it's his example. Okay, so he knows this client intimately, and this is what the case study is all about. One of the bonuses of this session, I guess, is that whilst it's about MDBI underwriting, you're actually going to get a good demonstration of what a truly professional and experienced broker adds to the mix. Because this client that Phil's going to talk about is insured directly with State, and the client wants a broker to come in and review the program. So this is a really good example of the value that a broker can add. Now, finally, just before I hand over, one last thing. We have got quite a bit to cover today, and we've only got an hour. We want to have you out of here by 12. So if we do, and it is a workshop, okay, it's an unscripted discussion, so if we do start getting sidetracked on any issues, we may just have to park it, but I'm more than happy to leave my details and carry that discussion on in the next week or so over email or phone or whatever. Okay, so at this point I'll hand over to Phil. More forms.
Sorry, if we've run out of forms, we didn't know how many were attending. There may be the odd one lying around. Oh, here we go. Sorry, we've got a couple of spare here. Yep, thank you. Right, I'll have to speed it up because, in fact, we actually filmed this thing on site, and I didn't realise it was only an hour. So, and the guy that I interviewed took so long to talk about his business that it defeated the whole purpose. So I'm just the owner of the business. You'll have to take me as the owner. But this is a client of mine who's involved in metal spinning, and the company's been going for 60 years. And they're in Auckland, and they use hand lathes, which are about 50 to 60 years old, where they have dies and moulds, and you clamp metal onto them and you hand spin them. And then they have CNC PLC equipment, which is obviously more modern and geared up with CAD systems. And then they've got 5 bliss presses. And these presses, the biggest one is a 600 tonne. And they make the cylinders, the tops for water heating cylinders. They manufacture their own product and sell it, or metal products, and it's light engineering. I stress light engineering. So they've got all these heavy machinery, which is actually over capacity. They also do 50% of their work is subcontracting for other people. So in their premises, they have raw materials like copper, other sheeting, and their customers' dies and moulds, tooling. Now, the client, it says here, the outline is actually wrong now because we couldn't show the film. And it would be a good one. We've still got the movie, so we might actually do that as a course some other time. But the client, I'm interviewing him, all this information comes out, and the purpose is I've got to go away and re-look at what the material damage policy should be structured, how it should be structured, and look at the business interruption. He's also got a new machine sitting plastic wrapped in his premises that's just come in. It's worth $1 million, but it's not going to be used yet. It will be used in the future to generate income. And if you look at your sheet, you'll find that we've got the name of the company, the facts sheet, what his business activity is, where he is located. We've got his turnover and projections for the next 2 years, common renewal date, and his current schedule that he's given me from State shows that he's got $9 million on plant and machinery, replacement value, $200,000 on stock, $100,000 customers' goods, for which he's legally liable, standard industry excesses, and the owner of the business, because it's unique to him, this type of work, he's got a good handle on what the actual values are. And he probably has convinced me that he currently knows, as at today, what it would cost to replace his machinery, as at today. And he's given me his gross profit sum insured, standard state policy with 5% sublimit on the extensions, plus he has other policies, obviously. There's no breakdown or profits breakdown. We can touch on that, but the emphasis here is on actually the asset insurance under material damage. And the background is there. He's been with the state for 10 years. He's only had one claim. It's a burglary for $5,000. And the survey of the premises scrubs up. There's no issues on that. And it says there he's making these metal cabinets for himself, plus contract manufacturing. And there, some of the page is his key customers. And I told you he's got raw material and dyes and moulds that belong to his customers. And obviously we've got raw material, work in progress, finished goods, $500,000 at peak. And that includes sheet metal purchased for the manufacturing of his own product and for customers' products. And there's the list of the machines. 5 35, 40-year-old spinning lathes. They are available in the market. There's the 600-ton Bliss press. And this is quite common. People buy these items of plant at an auction or for a cheap price, and often they're not designated for the particular task involved. But so he's got this huge thing he bought for $100,000, but it would be $2 million to replace it. Plus he's got a 250-ton, a 150-ton, and a 130-ton press. There's the values. There's the CNC PLC equipment. Tooling, which is dyes and moulds, and other plant. Now, if you walk around the factory, you'll notice that because of the size of this equipment, most of the motors are in excess of 10 kilowatts. And then I've told you about the new machine that's arriving, has arrived, and it's starting up soon. And then his process, and what sort of products he makes for customers. So he makes them and then he sends them out to other contracting companies for powder coating, anodizing and polishing. And they come back to his premises and he packs them and sends them out to the customers and to the contract manufacturing customers. Obviously there's a bit more information here on other things like transit, which we won't probably get into at this stage, but it's other trigger points. And he's also mentioned that he has long-term relationships with his customers and suppliers. And nothing's really changed in the last 15 years. It's an old family business. But with some of his subcontracting customers, there are contracts which contain fines and penalties for non-completion of orders or late delivery. He doesn't do any exports directly or indirectly. And over the other page is his appraisal of these machines, which all comes up to $9 million. That new CNC machine that's going to come online is going to generate, it should be 2013 and 14 year, sorry, instead of 12-14. But that's going to increase his sales by 1.3 million, and the efficiency of it will mean his cost of goods sold will actually decrease, as his expenses will decrease by 5% a year. So what we need to do is consider that information and say, how would we construct a material damage policy in terms of sums insured, basis of coverage, where it's covered, and what are some of the trigger points that you consider that we should be looking at. So what I'd like you to do is to get into groups, say 5 or 6, talk about it, and then come back with what your suggestions would be. We don't have to worry about the underwriting in respect of it's all concrete, adequate fire. An underwriter would be very happy as a risk to put on the books. There's nothing, the requirements there. It's just how would you structure the program for him. So if I could get you guys to do that, and do we have how many minutes we're doing this? So give you, say, 10 minutes. Okay, guys, we'll get some answers off you now. Take this team here first. We'll what are we going to change? What are we going to do?
Well, obviously, first thing you're going to do is change the gross profit so it should.
Yeah, brilliant.
No, he's not. He made a loss.
Net loss is not a gross profit.
Okay, so what are we going to do on the MD?
On material damage, it's plant value. Yeah, we recommend against plant value. Reliance on client industry knowledge of replacement values.
Right.
Despite the fact that they may work, and there's many of them in Christchurch who said, I know one of my goods isn't worth most of their hands.
Good point. Plant valuation. Anything else?
Yeah, so insured locations, yep, good point. Because at the moment there's just one location insured.
And relevant to that is obviously that on some insured locations.
Yeah.
Natural disaster issues.
Anything else, guys? On the MD?
Yeah, spot on, yeah.
Will insurers give agreed value at the moment?
Yeah, so we want to get the plant valued, but we also want to establish what the basis of valuation actually is. It might not necessarily be replacement value, yeah.
And I'd say actually what redundancy he's got built into the machines he's got at the moment.
Yes, yeah.
Capacity. In other words, one machine be able to be used for the other.
Duplicity of machinery.
Duplicity of machinery.
Any other groups got any more to add?
That's a good point. It's really critical to establish the ownership of customers' property. I mean, insurance policy can cover anything, provided the client, the broker and the insurer are all on the same page and know what's being covered, and we sort out the insurable interest issues, obviously. But that's a really good point, yeah.
Sorry, I'm partly deaf, so I can't hear that.
Are you saying it's a... Oh, yeah, well, in terms of breakdown there is. Like, are you talking about machinery breakdown?
No, not applicable.
Yeah, if you're getting into like mobile plant maybe in a civil works scenario, absolutely. But in terms, this is just a basic standard manufacturing type risk. The material damage is perfectly adequate for that, yeah. But there is a breakdown exposure, which you do need to think about that and discuss machinery breakdown with the client, absolutely.
That new CNC machine,
Mm-hmm.
I don't think it should be at the business premises. It should be moved off-site because he's not using it, but it is brand new. If he has a fire there and this other machine is in a safe storage, he can immediately bring it back.
Yeah, yeah,
Good point. That's like a risk management situation. Has anybody got anything else? Sorry, I can't. Could you speak up? Sorry. Yes.
Yeah, absolutely. That's what we want to do, is put it under the MD policy. You don't want to get into a negligence argument in the event of a claim. You just want the MD policy to pick it up. Absolutely, yeah.
When you said it, looking at the sum insured for plant, making sure that you're making allowance for removal of debris.
Yeah, brilliant, spot on.
And any installation costs, because there might be, that's the value of the plant, but these are big pieces of machine, and there might be quite a large installation cost incurred to actually.
Yeah, spot the NZI property underwriter. Yeah, absolutely.
I know, but it's too late now to...
Well, you'd hear the rest of it.
Would you? Okay.
Everyone else would hear it.
Does everyone have one of these? Which I've never used. And if you've been to other sessions,
simply
you could
press
probably
the
use...
button and the microphone's on. Simple as that. And then
Okay.
everyone can hear your comments.
There you go.
How are we going for time? We'll just speed it along. Just any other points to add here?
Yeah.
Yes?
I came across a case a few years ago, and it's, let's say this building we're talking about was built 30 years ago.
Right.
Who owns the switchboard?
Well, unless he's refurbished the building himself and it's a standard lease, the switchboard's part of the building. But that's another underwriting thing, is you would obviously check that the capacity that this guy's got is... Has he got an outside transformer? How is he dependent on that? That's sort of like the underwriting information that you'd probably be looking at. In this particular... Oh, sorry. Sorry, yep.
Yeah, okay. The real problem with the issue was who actually owned it. Now, the problem is, I've got a bit of advice, is that we had to go back to the financials of years back of these people to see whose asset register it was in. What I'm trying to say to this audience is that you should always ask your clients to leave things in their asset register, even though it's not nil value, but it's still working in the company.
Probably check if there's any fit out as well in the building. There's nothing showing, but it's sensible to find out.
Sorry, who was that?
Well, I think every...
Is this going from the same speaker? Yeah, absolutely. It's a good point. Yeah, absolutely. In terms of trade,
No, one of those is also the problem with the actual electric motors, actually, because most of your policies have a
yeah,
5
spot
kilowatt
on.
limit, and
on.
so you need to actually either get the really nice underwriter to agree to extend that capacity limit, or talk to the client about machinery breakdown cover on those electric motors.
yeah, I mean, whether the underwriter agrees to do that or not is not the issue, but you've got to highlight it and at least raise that as an issue. And yeah, either get the underwriter to increase the kilowatt limitation, or push, discuss the breakdown policy with the client. Yeah, absolutely key point. Yeah, oh look, absolutely, because it's all very well. If a client doesn't want to insure a breakdown might not be the real exposure. The real exposure might be in the BI. And one thing you might want to consider is with your client, if the client doesn't want to pay the money for a breakdown policy, you might suggest, well, take a really big deductible to keep the cost down and get access to that BI cover. But in a manufacturing situation like this, and I don't know whether I think it's in the handout, there's a 9-month lead-in time to replace that CNC machine. So that's the profits is a real problem for the breakdown profit is a real problem for this client. So that's a really good point.
In this particular case, the guy did actually go and get a valuation, but the value actually came into the meeting. And what we ended up doing was that 600-ton Bliss and the other big machines, which were over capacity, we ended up doing functional replacement value. The big CNCs, the more modern machines, were retained on full replacement value. The old hand lathes, we did refurbished indemnity value because most of them had to have upgrades done when they came in. But we at least established what was critical to his business, and the duplicity of his machines meant that it wasn't too serious for the old spinning lathes, but the CNC machines were the big ones. In the discussion, he said he didn't need breakdown because he had all these extra capacity and duplicity. But when we actually dug deeper in, most of these CNC equipment came out of Italy. And although we could get parts in, the profits was the big issue, BI. Also, he relied on old-fashioned relationships. He had no terms of trade with his customers and suppliers, couldn't enforce payment. So we had to introduce terms of trade and establish in that terms of trade who was going to be responsible for loss or damage to the tooling and the customer's goods. And because of the nature of the beast, we actually insured it under the material damage policy rather than relying on proving negligence, as Matthew was saying before. So for the benefit of his customers, we actually insured the dies and moulds and the work in progress and raw materials and finished goods under this policy, and reflected that in the terms of trade and the fact that he also sent the goods out on behalf of his principals that he manufactured goods for. And obviously we had to add the extra locations and the kilowatt situation. And that sort of, at the end of the day, sort of ticked off most of the boxes of what we sort of been looking at originally. But has anyone got any other questions on that?
Sure.
I'll speak up. What basic valuations did you use for the dies and moulds? Because although they're higher, the object would just be refurbished. The cost of remaking.
Well, what you're saying is 100% right. Today, though, what's tended to happen is the cost of those toolings, for the nature of what he was doing, wasn't that expensive. In reality, what we did, we had backups off-site as well. It's where you get someone that's unique, like a shipping company, a company that makes winches for luxury yachts. The lead-in time's 5 or 10 years. So if you had all your dies and moulds in one factory, you know, your history. So all the insurance in the world isn't going to do that. So we actually got the client to move those toolings to different sites and got different foundries to do different work.
Phil, you also mentioned indemnity value on the older equipment, but you called it
Refurbished.
So what is the basis of valuation on refurbished indemnity value? Because I do know from when you're doing old machinery, you've got what they call expendable parts, which have wear and tear. So you've got to be pretty careful on your definition of basis of settlement.
Generally, what I've found with this is that they can get a machine for 400,000, and it may need, because of the way that particular machine has been set up, they've got to reconfigure part of it so that it actually works in the environment for which the guy has bought it for. So just often the valuer in this particular case had an allowance of 100,000 for such work to bring it up to spec. I mean, every case is different. I mean, every type of plant is different. And so it's just a matter of structuring the valuation so that he is indemnified to the level he needs to be.
So where would you put that? Because what you really thought about is increased cost of working, which to me fits under a business interruption policy.
Well, I'd disagree with you on that, on the sense that additional increased costs is made in order to minimise the interruption interference to the business. He's actually got these machines. It's just the replacement cost valuation of them. That's all we're talking about here. No. Okay. we're running out of time, so
Yeah,
we'll do the GP. In the particular interview that we did, the guy actually said, well, my actual gross profit was 1.3 and the insured gross profit's 1.5, I'm fine. So then he gave us the P&L and we had a look at that. And so does... what, in the current financial year, the actual GP should have been, yeah, which is the traditional thing of taking turnover plus closing, purchases and opening. The trick that sometimes in these things is that this is a manufacturing account, not a trading account, and you'll notice that wages for manufacturing is treated as part of the cost of goods sold, so you have to add that back in till you get your gross profit. It's amazing how many people out there that tricks them, but if you follow the formula of turnover plus closing, purchases and opening, you'll get it. And to prove that you're right, you just take the net profit or net loss and add back all the expenses and you'll arrive at the same answer.
Or you can just work out your cost of sales and go purchases and opening stock less closing stock, and then just take that off your turnover.
There should have been a note sent out from IBANZ about bringing a calculator along. Did anyone get that? Doesn't matter. It's not that important. It was just to go through the exercise. The interesting point sometimes with business interruption policies is sometimes we forget to look at the insuring clause, and it refers to damage to property at the premises used for the purpose of the business. So if you've gone out as a broker and you will have increased the sum insured on the material damage policy to cope with this new CNC machine. And he's already told you that sales are going to increase and expenses are going to go down. So you're going to trend out 2 years out. Should you look at the wording, though, again on your policy? It's damage to property being used, not to be used. So that machine technically is not an even... It's sitting there, idle, but maybe... I don't know, just the point, you should look at the words of used or to be used to be included within the... So rather than just increase the sum insured, you've got to think about the policy wording as it applies to the situation. Sorry? It's not advanced profits as far as I would see. But I'm not the underwriter.
Yeah, no, not. That's kind of a separate discussion, really.
We'll give you a handout takeaway thing with some of the suggestions that we've put on here. And I mean, I've just basically given a little calculation of how you would increase your GP sum insured by the 10% each year. You've already got down here that we're reducing the cost of sales by 5%, so your rate of gross profit has increased. And in actual fact, we'd be looking at about 7 million roughly as the gross profit sum insured based on a 12 months indemnity period. And with obviously you'd increase that for 18 or 24 months if you can get that in this market. But has anyone got any other questions?
Yeah,
Right.
spot on. Spot
Yep.
on, yeah.
Yep.
I just want to flip that over.
That's all right. Yeah, dependency limits. In this particular case also we had him, and take your point about the asset register. A lot of clients, as you say, when it drops off in value, drops off their sheet. Well, generally those sheets are stuck in there for your books of account for depreciation purposes. They're not a true asset register. So I mean, we generally would go to a client and get his secretary to walk around and actually itemise everything that they own, and do that as an exercise, and it might even go down to be staplers or whatever. And you'll find that in general cases the client's always underinsured, and there's no allowance for debris. That's the big thing. Brokers, mostly sums insureds, are inclusive of debris costs, and often in our haste we forget to actually top up the sum insured to cope with it.
We're going to do the exercise or just wrap it up?
Let's just wrap it up, I think.
Just talk about it. Someone raised the point about the dependency.
Yeah, is it, I mean, someone else did, but is it really because the dependency is 20% of contract manufacturing turnover, which is actually 80% of the total turnover. So technically it's only 10%.
Yeah.
So if your policy, which is mostly 10%, but we might want to review that.
Yeah.
Yeah, I think in this case the policy, the expiring policy was 5%. Yeah. And so if you take 20% of half of 13, so 20% of 6.5, it's what, 1.3 or something. Yeah. It may well be. It may well be adequate. Yeah.
I'll leave these by the door if you want to take one of these as you leave. It's the just basically the summary of the interviews that were done. As I say, unfortunately it was filmed, but it was far too long. We'll review that, and it might be a separate course because it goes into a lot more depth than what we covered. But with 1 hour, it's a bit limited. But it was just to give you guys an idea of how much more you can actually go with your client. And in this particular case, we went down from 9 to 6 million. It wasn't huge premium saving, but he felt that it was doing the job correctly. It was offset by the fact that he had to pay a bucket load more for his correct gross profit sum insured. But at the end of the day, we got it all covered off, and he didn't take breakdown, but we actually increased the horsepower limit under the Fusion extension. Anyway, we'll leave it to you to close up.
Okay. Well, we're going to go through the BI exercise and just do those trendings for the next 2 years, but we're a bit late starting. But the key point with the BI was the fact that the gross profit was incorrect. The indemnity period is clearly too low. I mean, it's taking 3/4 of the indemnity period to replace the CNC machine, so there's no way you're going to get the profit back with that period. The dependency, the customer suppliers limits were too low. So that was the main point with the BI. In terms of the increase, that was just a simple mathematical calculation, but it was getting that gross profit right in the first place. So we're going to wrap that up. I hope that's been of some help and some use to you guys. As I said, if there's any issues that you don't think have been addressed adequately, or you want to take up, do leave your details or just tap me on the shoulder. I'm happy to carry the discussion on. Are there any other questions to finish it off? All right, well, thank you very much for your time and attention. Cheers.
Great. Thanks very much.